All right. So here's the title then. I apologize to all of you. I'm really have to learn how to do this, and I have tried. Anyway, banking on the state of political economy, banking on the state, and the title of the book is called The Political Economy of the State. And it's written by Mark K. Cassell, Cassell, and it has to do with the public banks in all of Germany. It's called Sparkassen. So let me just, well, why doesn't it change then?
There you are.
Okay. So here's the some of the things that people have said. So here's the German private commercial banker, right? That's just like any commercial banker anywhere in the United States. And he says public banks like Sparkassen shouldn't really exist. And here are the three very interesting puzzles. Firstly, the public banks of the public banks of Germany are relatively small financial institutions, and yet they account for more than 40% of all business lending. It's really quite extraordinary. Secondly, in a global financial system, locally owned small banks cannot survive. And yet, not only do they survive, but they actually thrive. So this is an attempt to respond to people who say why public banks couldn't function. They're just too small. The financial system is really international and global. What can really small financial institutions like public bankings do? Well, here it is that in Germany, where they're very widespread, they have 40% of all business lending. Also, not only did the small public banks survive, they more than survived. They continued to do well, whereas the global financial system was on the verge of collapse, and it only didn't collapse because of the enormous amount of money that was poured into them. And also, as we all know, none of the great bankers were ever uh, uh, indicted, let alone brought to trial, let alone convicted. Whereas, as some of you might know, in Iceland, which is 1% of the population of the United States, there were approximately, I think, 26 bankers or so that were not only indicted, they were put in prison because the prime minister at the time said, I'll be damned if I'm going to sacrifice the Icelandic people to the bank presidents. And then the third thing is during the recent 2008 financial crisis, big banks gambled on mortgages and derivatives and lost. Where Sparkassen lent in their own region, this is really quite crucial, and continue to draw profits, not draws, but draw profits. So this idea that small entities and even a large number of small entities can't make it, not only can they make it in a better way than the big banks. And then the question becomes, well, why did they do so well? First principle is that they went by regionalism. They lent to people they trusted and were in turn trusted by. Yes, they know the people to whom they loaned money, and the people that loaned the money, that put deposits in, and not loan the money, but put deposits in, um, know the bankers. And so there is a trust that goes on from one place to another. Very good organization with superlapping supervision by multiple constituent interests. This is very, very important, and this is something that we haven't altogether solved in our, in my estimation, on our legislation that we put together, and that is how the governance of the bank. That you need to have people from the general public and not just bankers or former bankers or politicians or business people. You need to have that representation, but you need to have very wide representation for the governance itself. And that's what the sarcasm has have achieved. And finally, the sarcasm have political influence. This is really quite crucial. I mean, the I don't know exactly, and Earl might tell us about that, how much political influence the Bank of North Dakota has on the political establishment. But in the case of sarcasm, they have very great political influence. They are not just subjects, they are agents. That is to say, our experience with the politicals of Colorado are essentially they listen, after we bug them quite a bit, but I don't feel as if I'm a real agent in the political arena. My now orientation towards politician is, look, buddy, and not without I don't mean to put them down, but I want to establish the healthy relationship between a citizen and a politician. And that is that a politician is a servant of the citizen. And I just don't get that sense from the politicians in Colorado and probably politicians in the United States and probably politicians everywhere. They seem to, instead of being kings and queens, they still have, I feel the sense that they are relating to me as princes and princesses. And so, in the case of sarcasm, they have more than half the citizens have deposits there. So they really have a direct say, not only as a depositor, but also as a citizen. And this is something that I certainly have not solved about how to get people to understand what their position is. And it's the position of a servant. That is to say, it doesn't mean that they are servants. They're servants with respect to the citizen, in their own private life. Elsewhere, in very many other places, they might not be servants. It was other people that serve them. So, for example, you go to a restaurant and somebody is serving you. They need to listen to what it is that you say, what is it that you ask for, um, your particular tastes, etc. That's what makes a good server. That doesn't mean that that server is a server per se. It means that in this situation, that's how he behaves. So, okay. And this one is another one of those sarcasm CEOs where he says, we are for profits, not for maximizing profit. So, this is a very good way of undermining altogether when certain people say, well, what, you want people to work for nothing? Are you against profit? And the answer is no. I'm in favor of profits, that is to say, just remuneration to your contribution that you made. What value have you provided? Not um, getting more profits than what is due to you, because that extra that you get is not really due to your creativity, your work ethic, etc., but it is due to rent. That's what that's what you do with maximizing profit. Is it's another way of saying I'm collecting rent, economic rent. All right. So under law, they are to respect the following principles: ensure access to financial services to all individuals. That's the notion of inclusivity. And without that, you can't have democracy and you can't have justice. So it's access of financial services to all individuals, like we want the internet to be accessed by all individuals. You want all individuals to have access to the protection of the law. You know, that's part and parcel what it means to live in a democracy. So it ensures access to financial services. It doesn't say, well, we'll see what we can do. It says, that's what we're doing. And any obstacles to that, we'll see to that these obstacles are removed. Promote savings and the creation of financial wealth. Yes, savings, not just consumption. You know, with the big banks, you get credit cards. Credit cards just influence you to buy more and more and more. So it's promoting savings and creation of financial wealth. Now, of course, they also tend to have very good economies in economy in Germany, but that's partially the result of the Sparkassen. So it means that once they've been successful in creating a good economy, they say to their customers and to their citizens, listen, we'll help you to see to it that you uh, uh, put some money aside so you create financial wealth. And not only that, but what I read in this book is that financial education in schools. I, I went to very good schools. I was just lucky. I went to very, very good schools. And I never had any financial education. Even economics, which is falsely connected with finance, which it is not really in the teaching of it, never even heard of something like that. So given either for you to learn on your own or through your parents, and the parents might not be very good themselves. Because it's not only logical stuff, it's also dealing with the emotional makeup of a child as to get to see them that more is not necessarily better. Maintain a presence throughout the geographical area, including rural areas and regional business. Yes, all the big banks barely ever look at rural areas, ever. I mean, this is one of the things, by the way, that in the Rocky Mountain Public Banking Institute, we're very big on, is that we commit ourselves or commit the people who will run the banks, the public banks in Colorado, is that they pay attention to the rural areas. And even more than paying attention is to find out what it is that they need. Find out, go and speak to them. Just like, some bankers come to your office if you're a rich person and ask you, how low can I bow to you so that you deposit some money? Here, you go out to these geographical areas and rural areas and regional businesses, and you ask. You ask, you find out. Okay. Yes, this one is I like very, very much. So this is the definition of community. The health of the bank and the health of the region are intertwined. The causal arrow goes both ways. This is a Sparkazan CEO. In other words, I'm not in business to make money at your expense. I want to have money in my coffers, in my as deposits, in order to loan out capital, in order to benefit ourselves and you. And if you, and not you as a person, but you as a community. So if I don't do that, then I shouldn't be CEO. That's as clear as day. Okay, I'm going to use one of the graphs that I used last time. Um, this cross. So remember that I said that democracy and autocracy, peace versus war or nonviolence and violence is the what I consider to be the principal political existential problems that we all face. So what I'm getting at with this, that I didn't exactly mention it last time, is that if we're in public banking, or if we're in favor of universal basic income, or if we are in favor of taxing, uh, billionaires, do I know, or other millionaires, rich millionaires, then we've got to show that this particular policy that you have contributes to the resolution of democracy versus authority and peace versus war or nonviolence versus violence. Otherwise, I'm not listening to you, because these are the questions that are the existential questions. They have various other um, important issues below each of them, but those, to me, that's what I've come to. And this is a temporary, obviously, uh, mm, uh, conclusion, but that's what I've come to, at least up to now. On the economic side is the distribution of wealth and power and debt, which is very unjust. And so, again, how is it the public banks can contribute to the resolution of this issue, this existential issue? And finally, steady state economics, which is the no growth economics of Kenneth Boulding and Herman Daly and people like that, and now increasingly more people. And, if you're not contributed to any one of those, or even more of those, then what you propose is more or less useless. So, you know, to, and that it's a waste of anybody listening to you. So that if you're interested in Black Lives Matter, for example, well, you'll go to the distribution of wealth and power and debt. You can contribute, you certainly would contribute there, and you'd also contribute to democracy and autocracy. So it's just not only good, but wonderful to be interested and to be working at that issue through this kind of orientation. And one last thing that I found um, between this time and and now, between last time and now, is that we use the word total usually in one meaning, and the meaning of it being totalitarianism, control of individuals by the state. But it can also be a control of individual by members of the group. And it's been given a different name in the literature called totalism. So I would say that, um, uh, with banking, for example, that it belongs to totalism, not to totalitarianism, right? But just because it's not totalitarianism, it doesn't mean that it's not very good in this sense of having control of individuals, but by members of a particular group. So it can be the case with respect to um, uh, 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 people with guns imposing their will on other individuals, rather than either convincing them or having a vote or doing a whole variety of things. So that's it. Sorry it took so long to start with. So
Okay, you need to unshare your slide.
yeah. Okay, so you say, but stop share. Okay. Sorry for the late start, but it amounts to 20 people instead of half an hour that I claimed.
Okay. All right. Well, here we go. I'm going to share my slide. All right. I showed this slide before, but we're talking about the Bank of North Dakota. And I thought it's well worth repeating a few of the basic facts about it. Going back to the beginning, on the cartoon at the left, you see what really amounted to the bankers saying, no thanks, we want to take over lending, and they also took over storing grain and other operations. In lieu of the big banks controlling their economy and extracting lots of interest, and the railroads and granaries, these big businesses taking money out of the state. And they had a huge fight for 2.5 years, and it wasn't clear whether the bank would survive. They had several legal fights and referendums and 9 votes of the people, and they finally succeeded. And a group of bankers helped out from Ohio and bought their bonds, $12 million bonds, which certainly helped them get firmly established. So that's now 103 years. They, of course, escaped the 2008 Great Recession with increased lending, the nation's lowest unemployment rate, lowest default rate, and things like credit cards and student loans, and one of the lowest home foreclosure rates. They've had no bank failures for many years, 20 or more years, which is by far the only state to do that. Because there have been many bank failures, I know, in Colorado and every other state. They have the most banks per capita, roughly 4 times the national average. And that's because they preserve the small local lending banks. And their profits, not only profitable for the last 20 years, but they far exceeded Goldman Sachs and Chase, according to an article in the Wall Street Journal, and that's still true. And this also is a reminder of some things we mentioned before, but how do they maintain such profitability? And every one of these things is very different from the big private banks, or private banks really in other states other than North Dakota on some of these things because of their joint lending. Very low overhead is a very marked trait of the Bank of North Dakota. And here's how they do it. No high-paid CEOs or big bonuses. Advertising is eliminated. That saves tons of money. You can hardly watch a sports event without ads from the big banks. No taxes to pay. Massive deposit base, and that's where they should go. Because when the state deposits all the revenues in a big private bank, that bank can use our money to create maximized profit for them, so often at public expense and risk. no private shareholders, so they don't have to pay out money to people outside the state for dividends. Instead, the dividends of the bank, the income, can be shared with the state and with their general fund. They partner with local banks and credit unions in making loans. In this respect, they're different from the Sparkassen in Germany because they directly take deposits from citizens, savings deposits. They are city-owned and nonprofit savings banks, but they're all over the country. And North Dakota achieves a similar result by making loans jointly with these local public banks. So you do have local lending on a regional type basis, comparable to North Dakota, where the bank is lending locally to people they know and trust and have a chance to watch closely to help them when they need it, and in very rare cases to foreclose, but mostly to keep businesses going, agriculture, and so forth, so that they pay their loans and they have a very low default rate. By partnering with these private banks and credit unions, they avoid having the expense of a branch office or any branch offices. The local bank or credit union initially takes the application for the loan and decides whether they want to grant it. And in many cases, they then approach the Bank for North Dakota and ask if you want to participate in this loan. The bank then reviews it, which helps you have a double layer of review to help ensure that the loan will be repaid. And they don't have ATMs either. They also do very safe lending. Their goal is to make sure the loans get repaid and that they serve the community. And that also contributes to their very low default rate, which is lower significantly than default rates of private banks. Another factor is not paying commissions or fees for making loans. That has several benefits besides keeping their overhead low, but it also reduces the risk, because paying commissions means if you're paid up front, you don't care whether the loan gets repaid or not. You've already been paid. And that led to a lot of what were called liar's loans by Mr. Black, who helped clean up the Savings and Loan Association debacle 40 years ago. The profits then are used to increase the capital, which of course allows increased lending because you can lend up to roughly 10 times the amount of capital, or the profits can be shared with the general fund or the government. And therefore it comes back to the people. And of course, this amounts to a large new source of income from the people's money, who should get it, without raising taxes. It's a way to be able to reduce taxes. In fact, North Dakota reduced their taxes in the state back about 7 years ago or so by about $900 million, because they were doing so well after 2009 through 11 or 12 or so. That's very rare, of course, but that was a lot of money to pay back to taxpayers. How did the Bank of North Dakota avoid recession, as we mentioned? First of all, they avoid bubbles by not paying commissions or fees for making loans, by not lending for inflating existing assets, like especially real estate, with a huge real estate bubble that crashed in 2008, or stocks that crashed in 1929. And they also inflate other assets, which do not help the economy. They make safe, non-speculative loans, especially for new business that's productive and does not inflate the economy. When the economy declined, this is another major distinction in behavior between a public bank like the Bank of North Dakota and private banks. which are only thinking about their own shareholders and their own personal profits. So what do? They cut lending. And that, of course, aggravates the recession and plunges it into a deep recession as it did in 2008. Bank of North Dakota did exactly the opposite. They increased the lending, didn't have to be increased a great deal, just enough to offset the recession. The result was the economy remained strong and they had record profits each year from 2008 and after. So with countercyclical lending, you have many benefits, but chief among them, you don't create bubbles. You don't cause recessions that result from the bubbles, and you prevent recession by increased lending in a recession. And this makes the so-called business cycle that is just routinely taught as if it's inevitable in business schools and finance schools, a totally unnecessary evil. And people need to know this, and we need to widely educate them that the whole basis for business education and finance education is fallacious.
And economists say the same thing, by the way.
Yes, excuse me. Here's a wonderful study that was done in 2008. This was in South and Central America by a body of the UN looking at finance, and public banks and private banks were compared. And you see on the left in orange, you see the private banks and what they did for lending. They all decreased lending. You see the negative percentages. Brazil, the least. Argentina, you don't see any private banks in that study. And you see not huge decreases, but when all these banks together decrease their lending, if there were no public banks, it would collapse the economy. But what happened was they have public banks in those countries, and you can see very distinct amounts of lending. Chile's more politically conservative than the others, and it was there that the public banks increased lending by 20%. That helps greatly to prevent recession. And this study is a confirming example of the behavior of North Dakota's bank and other public banks like the Sparkasm that Alec talked about. Elsewhere around the world, they're able to help avoid recession or certainly greatly lessen it, depending on how much of the economy they constitute. And then there have been critics of the claim that it was North Dakota's bank that enabled them to avoid the recession in 2008. They say, oh, it was their oil. Well, that was a factor that helped their economy, no doubt about it. The biggest increase wasn't actually in 2008, but a couple of years later. But other states that had as much oil, like Montana and Alaska, still had high unemployment and budget deficits in 2008 and beyond. So this is more support for the fact that it was the bank that was the principal factor in their avoiding recession. They also actually helped fund the expansions of some of the fracking. We're not saying fracking is good, and North Dakota is a red state, and they have a lot of oil. In a more, let's say, progressive state or a blue state, things like sustainable resources and clean energy have been fostered much more. In fact, the Sparkasm, I think, as we mentioned, was the principal funder of the conversion to clean energy in Germany, which has been very rapid. Another example of how it was the Bank of North Dakota that saved the economy in 2008. In 2014-15, oil prices collapsed. And if it was oil that was the only cause or the principal cause, the economy should have declined in a major way at that time, but it did not. The Bank of North Dakota still had record profits and helped carry the state along in a similar vein. And then let's look at their countercyclical lending. The Bank of North Dakota, I went into their financial reports for 2008, 2009, and 2010, and they had their highest lending in 2008 and 2009, 11.7 times their capital. In 2009, 10 times its capital. In 2010, 8.6 times. Today, they're much lower, around 5 or 6 times their capital. But when they really needed it, that's what they did. And that's an excellent illustration, again, of how the bank played a major role in preventing recession. And again, how did BND fare in the COVID crisis? In 2020, the Bank of North Dakota had profits of 141 million. That's a very substantial profit. It was actually less than the prior year. First time they'd actually had smaller profits in any year for about 15 or more years. Well, actually closer to 20 years. But it wasn't that much smaller and was still very significant. And the return on equity was 15.5%, which is very good and generally less than the major banks' return. And then they just recently came out with their annual report for 2021, and their profits are increased some and still very significant at 144 million. The return on equity is still very high at 15%. Their total assets rose in 2021 up to 10 billion. And their total loans in 2021, 4.7 billion. That's, by the way, 51% of those loans are in small business. That's remarkable and an excellent example, again, of how productive loans that do not promote inflation and really help the economy grow instead of inflating assets is a major part of the Bank of North Dakota. I want to mention 2 other banks that are nearby. They're not in the United States, but ATB Bank, which is actually due north of North Dakota, is a publicly owned bank of the province of Alberta, Canada. It was founded in 1938. It has been the core factor, major factor in Alberta's prosperity. It has made Alberta helped make it the most prosperous province in Canada, and it pays more money back into the rest of Canada than any other province. That is also aided by oil. They happen to have a lot of oil in Alberta, and some of us might object to pursuing oil when they could be pursuing clean energy. But that bank has been very beneficial to the state in other ways for all types of other lending that have been beneficial. It's been continuously profitable. It helped Alberta through the COVID economic crisis. And its total amount of loans are really impressive, 44.6 billion in 2021. They had a little more in 2020. And they total assets, 55.7 billion. They're a little smaller than Colorado. We would have over $60 billion in loans if we had a comparable public bank in Colorado lending at the same rate. That would enable us to do an awful lot with affordable housing, with low-cost transportation, clean energy, and everything else that Colorado needs. And the same, I'm sure, is true in New York and the rest of the country. I also want to mention the Bank of Canada. It is no longer functioning as a public bank, but it did very successfully from 1939 to 1974. Gerald McGeer happened to be a mayor in British Columbia and head of that province, and was a Canadian parliamentarian who learned about public banks and played a major role in helping get the Public Bank of Canada established to lend directly to the government of Canada, starting in 1939 at the depth of the Great Depression. And within a year, it helped pull Canada out of the Great Depression. They did much more than the United States by having a real public bank. The United States had a bankers public bank, the Reconstruction Finance Corporation, and it did a great deal. But the Bank of Canada lent even more aggressively and helped pull Canada even more rapidly out of the Great Depression. They funded a big part of World War II, supporting the Allies. They made Canada continuously and increasingly prosperous over the next 35 years. It's tragic that that bank stopped lending to the government. But they had a very continuous period of prosperity, and it was probably bankers inside the Bank of North Dakota who had alignments with a private bank that made the decision to have it join the Bank for International Settlements, the international private central bank over the Fed and Bank of England and other central banks that required it as part of joining the BIS to have the bank stop lending to the national government. The idea is, well, that way the bank, the government doesn't have to depend on its own bank, as though that was somehow a good thing, which was a terrible idea because it meant that money that was now being channeled out of the public hands into private hands for private benefit at the expense of the public. And Canada's economy, just like the United States, has been steadily having increased debt. Democracy is being reduced as more right-wing government officials, and even, Trudeau is the son of a fairly moderately liberal progressive prime minister in Canada, but he's turned the same way towards this preservation of private control of the economy, and that really hurts the country. The other bank I want to mention is the Chickasaw Nation Community Bank. This is in Oklahoma City. Most people don't know about it, and I think that's partly because it's such a good example of how public banks are very good, and the big banks that have a huge influence over the media don't want people to know about that. It was founded 20 years ago with a very small asset base of 7.5 million. It has grown very rapidly. It now has $200 million in assets, and it's won several awards from banking institutions in the US for its excellent performance. And it was also rated the best place to work in North Dakota. It serves emphasis services to Native Americans. I believe it also serves others, but it's been an excellent example of how good a public bank can be. And finally, I want to show you a video by Richard Werner. It's a 12-minute video that I mentioned that I hope we can share with the volume. I may need your help, Ibrahim, to make sure that I get the volume playing. I'm stopping sharing, and I'm gonna, do I start by sharing my screen?
Yes.
Okay.
Before you start sharing, you'll have the option of sharing
Okay.
the sound. Yeah.
There I am. Shall I go ahead and try the, let's see if the sound is working. Okay, can you hear that all right?
No.
No.
No?
No.
No.
Why don't you send me the link to the video?
Okay, I'll send you the link.
Sure.
Do you need to stop sharing, Earl?
All right. I sent it to you. You should get it momentarily. Yeah, it shows up in my sent documents.
I got it. Hold on a second.
Good.
Hello, Bob Bongiovanni. Oh, I'll answer your question that you posted in chat in a short moment. Earl, I'm glad somebody's doing a little bit badly there in comparison to me. Just a little bit. I'm not.
I guess
You
we're
know,
not primarily.
I made a quick calculation of the how much a president would be paid for a public bank versus Chase. You know, the Chase banker, Diamond, and he gets $32 million a year. So our local public banker would get paid 320,000. So that's 1 times 100.
Yeah, that's shocking.
Shocking, yeah. There it is. But we still can't hear.
To them.
Oh, there.
There.
Oh, very good.
Yeah, that just takes a few seconds.
This episode is a more detailed follow-up to my 2017 video, Who Controls All of Our Money? I'm going to focus on the United States in this video only because they're the world reserve currency. But everything in this video affects all of us because the central banks around the world are all doing the same thing. With that being said, let's begin. Around the world today, we see central banks printing money.
Not it.
So here's a question. We're told from a young age that money is hard to come by. We should.
It's supposed to be a 12-minute segment, but Werner only.
What's wrong with our financial system?
Oh, there.
That's it.
I would like to ask 5 questions and give answers to them. Number 1, where does money come from? Very briefly, since we have a fairly educated audience here. Number 2, what causes the recurring boom and bust cycles and crises, which are, of course, recurring events. We've had over 100 just in the last 40 years worldwide. Thirdly, which policy has historically, based on empirical evidence, been most successful in avoiding these cycles and crises that we observe at high frequency? And number 4, what sort of structure of the banking sector has achieved the same result as that policy? And number 5, well, why are we in a recession in the UK? What is necessary to end it? So, well, we've established that the money comes from the banks, and they create, in the UK, 97% of the money supply. It's not the government, it's not even the central bank. The commercial banks are the creators of the money supply. How do they do that? So when someone takes out a loan, the bank simply pretends that the borrower has paid in the money as a deposit, when actually, of course, neither the borrower nor the bank nor anyone else has paid in the money or transferred it to the borrower's account. So what the bank does is it creates a fictitious deposit. And since banks are the accountants and run the settlement system of economic transactions, the accountants of the economy, nobody's able to tell the difference between real deposits and fictitious deposits. And obviously, as we know from aggregate data, the fictitious deposits therefore dominate and are 97% of the money supply. So especially speaking here, the Institute of Chartered Accountants, we believe the banks are honest accountants, but actually, of course, they're very creative accountants. What about other forms of the money supply? I mean, there are other forms of the money supply, such as, well, Bank of England notes, or in Scotland and Northern Ireland, paper money. Well, Scotland and Northern Ireland are special cases where commercial banks also issue paper money. In terms of size, that's very, very small. So the Bank of England issues roughly 3% of the money supply through its note issuance. And of course, that's a drop in the ocean when it comes to economic transactions, so it's tiny. What about this quantitative easing that we've been hearing about? This mainly creates another type of money, if you want. This is the central bank purchasing assets, resulting in banks accumulating credits at the central bank. These are the bank's reserves at the central bank. Now that is accounting money that stays at the central bank and never leaves the central bank. It doesn't circulate in the economy and therefore can't directly help the economy. So what we need is actually bank credit creation. That's the current system we have. We're entirely dependent on the bank's actions because they are the ones that create and allocate the money supply. They also decide who gets the money, the credit, and for what purpose. And that decision, of course, shapes the economic landscape. And funny enough, nobody's asked the banks to make sure that when they make this crucial decision, it's done in the right way for good things. No regulation asks banks to distinguish the use of the funds. In fact, there are regulations such as the Basel capital adequacy requirements, which punish banks for doing a lot of the good lending, for example, lending to productive SMEs, and encourage them and reward them for doing speculative lending, such as in the property market. So banks are the decision makers, and they haven't been told how to shape their decisions to serve the economy and its needs and the public good. They do it to, well, maximize their profits and bonuses. But of course, that decision can lead to good and bad results, and sadly, more recently, we've seen more of the bad results. So the second question, what causes the recurring boom and bust cycles and crises? And that's been a big mystery in economics, because economics and finance has neglected the reality of bank credit creation. So they haven't been able to explain this puzzle. It's now over 20 years that I proposed a very simple model that could explain these cycles and quite a few other puzzles as well. You have to separate this money creation, the bank credit creation, into two streams: money used for GDP transactions, which is money going into the real economy and determines GDP, and credit, bank credit used for financial transactions, which are not part of GDP, capital gains oriented, determining the asset prices and asset markets, and those are always unsustainable. So if you see those expanding, you know it's going to lead to problems. They're always unsustainable because there are no underlying there's no real generation of income gains that could service and repay the loans. All we have is capital gains, which are driven by the very credit creation. So it's a Ponzi scheme that is unsustainable, must end in tears. So if you separate credit creation into these streams, it's quite obvious what's happening. And very briefly, there's three scenarios. When credit is used for the real economy, even there's good and bad credit. You can either have the right-hand side, the green box, growth without inflation. When credit is used for productive purposes, there's more money creation, but it's used to create more goods and services, implement new technologies, increase productivity. So then, of course, you have no inflationary pressure because you've got more highly valued things for the money creation. And of course, inflation without growth is when credit is created by banks, used for GDP transactions, but not for investment, but for simply consumption, consumer credit. You have money creation. You've got more demand for goods and services, but not more goods and services. Obviously, prices will go up. And then we have credit creation for non-GDP transactions, and that is financial asset credit creation, leading to the asset inflation and boom and bust cycles. Just very briefly, this, of course, is always preceding a crisis, this asset boom, and you see that this financial credit has increased. So the chart here shows financial credit in Japan rising from 15% of total credit to doubling 30% in 10 years. In the UK, credit for the real economy, and that includes mortgages for, to keep things simple, accounted for only 22% of total bank assets in the past decade. So the majority, of course, has not helped the real economy. So what you have is out of control financial credit, and that creates the crises. Here we have two examples: Ireland, Spain. I mean, there's a long list, of course, from Iceland to Greece we could show. And you see that when the blue line is ahead of the pink line, that is financial credits, the blue line is ahead of, or total credit creation, therefore financial credit is ahead of GDP, we have the creation of asset bubbles, and that leads to these crises. Now, very briefly, finishing off the last two questions, which policy has historically been most successful in avoiding these cycles and crises? It is, and that's the historical record, a regime of credit guidance, whereby the central bank intervenes in bank credit decisions and tells them, well, don't give the bad credit, financial credit, give credit for productive purposes. And it's also been very successful because the central bank has the authority to regulate this vis-a-vis the banks, unlike the Treasury or Finance Ministry. Banks listen very carefully to what the central bank says because they need the central bank and its interbank market role to stay solvent, and therefore they listen. And this is, of course, the core of the East Asian economic miracle model, introduced into Asia by Japan, into Korea and Taiwan as well, and then copied by China, the system of credit guidance, where the central bank restricts the bad credit and advances productive credit. Now, some people say, oh, credit allocation, that sounds, like a Soviet state. No, not at all. You don't need micromanagement. You don't need to tell the banks exactly who to lend to. You just restrict the harmful stuff by saying no credit for financial speculation. I think we can't ban speculation, as some people propose, and I think that's impossible, and we don't need to. You don't need to ban speculation. You just ban bank credit creation for speculation. You don't allow banks access to this public sovereign prerogative of money creation, and you won't get the asset bubbles. Remember, credit is always allocated by banks anyway. So let's make sure it's allocated in a sensible way. The other possibility, of course, is state money, where banks are only intermediaries. Why should money be safer with a stockbroker than with a bank? It's a very odd system that we have. Finally, what structure of the banking sector has achieved the same result as credit guidance? Well, it's the key example is the structure of the German banking sector, where the 42.9% you see here are savings banks, and another 27% are cooperative banks. These are, so 70% of banking is not for profit and lending for productive purposes. Then you don't need the credit guidance regime. That's another way of achieving this. And finally, why are we in a recession? Well, you've seen from the quantity theory of credit, and I'm glad that Finance Watch has accepted this. I mean, in academia, there continue to be struggles surrounding this. And there were also when Finance Watch was founded, but I'm glad that this approach has been adopted. Why are we in recession? Because there's not enough credit for GDP transactions. Very simple. That has been shrinking, the latest data, by 1.4% of March, monthly data, and therefore we can't expect nominal GDP to rise. So we need to expand that, and there's several ways to do that. The fastest would be, and that's my last sentence, to re-intermediate government borrowing by having Her Majesty's Treasury enter into loan contracts with the banks, because they're the creators of the money supply. There's more reading here. Thank you very much.
All right. Well, I hope you like that. I think it's worth hearing from him directly. He's very clear, I think, and played a major role in figuring out how things actually work and making that a matter of widespread knowledge, although it needs to be spread a lot more. So let's take questions.
Earl, there are some things on the chat. There are either statements or questions. So one of them is from Yanis asking who the speaker was. What was his name? Warner's name.
Yeah, that is Richard Werner. He got his PhD in economics from Oxford University in the UK. He got his bachelor's degree from the London School of Economics in economics. He worked for 3 different major finance-oriented places in Japan. He had a role with the Ministry of Finance, with the Bank of Japan, and he also taught at economics at a university in Japan. He's the person who coined the term
Quantitative easing.
what?
Quantitative easing.
Yeah, quantitative easing.
Yeah.
But as he pointed out in his talk, he said that it should be put into the productive economy, not just given to banks that put it on their own books and don't put it into the economy, where it, as a result, does no good. So, any other questions?
Yeah, so there are some questions or some statements at the very top. It says from Bon Giovanni, who says Sparkasm banks and the Bank of North Dakota are saving banks, thus financial intermediaries. They make loans based upon their money holdings. Well, usually I think what people mean by financial intermediaries and savings banks is that they lend out of their deposits rather than from their capital. That's my understanding of a savings banks. Is that not true, Joe? You need to unmute yourself.
Go ahead, Joe. Should be able to do that.
Sorry. the question of the term capital versus their savings, to me, is I used it interchangeably.
No,
That
no,
is,
no, deposits
deposits
versus
savings-
capital. And anyway, they don't lend the capital, they don't lend the
They don't lend their
deposit.
equity. They don't lend their equity. I didn't mean to imply that. I merely used the term as the fact that it's in the savings account at the bank as being, the backup capital of the bank. So it's just a question. The question is only about whether they create the money. Ultimately, it's not a question of the nature of the assets that the bank is holding. It's not a question of that. It's just a question of what they used to lend.
Yeah, and what they used to lend is essentially nothing, right? Because they create it.
They create
Yes.
what?
Yeah,
The
their
deposit.
loans consist of new money that they create as a new deposit in the borrower's account.
Which,
And
yeah,
of course, it's a
literally.
new asset for the bank because there's the promise of the borrower to pay.
It's a
And
new.
that's exactly what Werner is saying time and time and time again, that he's shown that is indeed the case and not anything else.
Well, let me just make this point, okay?
Yeah, sure.
The lending that takes place, which Earl referred to it as money, it's not money. It's credit, okay? It's a credit lending by the bank, and that is exactly what Dr. Werner said.
Yes.
That's right. But he also said
it's an increase in purchasing power because it's an increase in credit.
Yeah.
But my understanding, so I want to get to the point that I was trying to make, is that the Public Banking Institute's public banking model is an advocacy for fractional reserve banking. And
Yeah, I
okay,
don't
I see Earl is shaking his head no.
Yeah.
No,
I
their
don't think
model
so
is
either.
for banks creating new money, and that's the only model that works. That's what banks do. They create new money. The
Oh.
fractional reserve system, as Werner proves in his articles, is not a valid model. That is not how banks create money.
Tell me what you mean
Each
when you say
loan. Go ahead, Joe.
what's not a valid model? I don't understand what you're saying, Earl.
Well, as
Not a-
Werner defines fractional reserve lending,
Fractional reserve lending takes place when just what the private banks are doing right now. Okay.
That's not what Werner claims.
well,
Wait a
they're not-
second. That's
they're
not
not
what
doing that.
Werner claims. What's what Werner claims?
let me explain.
Yeah, well, please, just one, and then let me.
Okay.
Yeah.
ahead.
Joe, the way Werner defines the fractional reserve lending is the theory that was promulgated back in about 1930 by a guy named Marshall, that banks don't create new money or new credit, as you put it, when they make a loan. Instead, it's a fractional reserve theory, which means they get a new deposit and they hold back 10% of it, and they can lend out the other 90%. And as they lend that out, a new bank gets that 90% of the deposit, and they can hold back 10% and lend out that. And collectively, the banks create new money. But that's how he defines the fractional reserve system. Some people still use it to mean the creation out of money system, but I think it's preferable to use Werner's definition, because that was how Marshall defined it, and how that was the dominant theory from about 1930 or 40 to 1960. And then the intermediation theory, which is that banks just lend money out of their deposits, which, as Werner proves conclusively, is not true. But in answer to your question, are banks creating credit or are they creating money? As Werner points out, they create it as credit and it's a new deposit in the borrower's account, but the banking system treats it as new money. So it's indistinguishable from money, even though it starts out as credit.
Credit is always indistinguishable from money. Always
Right.
They both impart purchasing power to the beneficiary of the transaction.
That's right.
Okay, but you're not kind of getting to my point, Earl.
Okay.
Because my point is, fractional reserve banking is what is advocated by the Public Banking Institute. Real fractional reserve banking, just like the private banks do it right now today. And I say, why? Why would you want to do that? You know, that raises the risk of all the Sparkassen and all the Bank of North Dakota models, because they don't do that. So you know, I just don't understand. I feel like the problem here is this is the thing that's keeping public banking from moving forward. Public banking would have a huge advocacy, you know, movement behind it if it wasn't trying to do what private banks do right now. So I think that, you know, if you got policy people, somebody should be talking. I'll leave it at that.
Well, let me answer that this way. I need to talk to Ellen and Walt McCree and others about their website, because if they're advocating the term fractional reserve lending, that doesn't really represent what they're recommending, because they are recommending that banks create money out of nothing, because that's what they do. But as Werner says, when the bank is publicly owned or it's a nonprofit, they focus on lending for beneficial purposes that help the local economy, for new businesses, to produce new goods and services, farms, and then also for student loans, which is beneficial and productive in the long term. And as long as banks follow what Werner was talking about and don't focus on lending to inflate asset values like stocks and real estate and other assets, what he calls financial, focus on the financial
Asset.
form of lending, then it is very beneficial to the community, because it does not promote inflation, prevents bubbles and recessions, and contributes to the real economy. But it has to be controlled by public interest to make sure it does not divert into either asset inflation or just for consumer lending, another form of lending that doesn't create new assets but creates inflation.
What, Joe, and then we might want to go to somebody else. Joe, what do you object to saying something like this? That the difference between a private bank and a public bank is that the public bank does exactly the same thing as a private bank in the creation of money, but puts that money in the service of goods that benefit the very large percentage of people, that is to say, to the common good, rather than private profiteering. What would you object to that statement?
Okay. Well, we haven't actually approached the Rubicon yet. Okay, which is that my understanding, constitutionally, the states gave up their right to create new money.
Yes.
Okay, so if they did what's a public bank going to be doing, trying to create new money? I don't understand that.
When you say the banks, the states, they didn't give it up. The Constitution said the states may not create new money by directly printing it the way the federal government could if it would, the way Lincoln did, for example. But it doesn't, the Constitution does not prevent the states, as North Dakota does, from creating new money as a bank.
Right.
Okay, I have to say this, Earl. Okay, I have studied the Bank of North Dakota's annual statement for the last 15 years. Okay, and if a bank has money and then makes a loan, then it's not creating new money. Okay, that's the point. The Bank of North
What do you
Dakota has
mean?
something like $5 billion of unlent
Yes,
capital assets. I'm going to call them. You can call them something
yes,
else.
yes, capital asset, that's right, that's true.
Okay, so they have $5 billion of extra money that they haven't lent
No,
out.
no, 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 they don't have it as extra money, they just have it as assets.
Oh,
And
assets,
then-
you have the extra money. It's like, why do the Chinese buy our bonds? You have the extra money, and there's the ability, and so they go out and buy bonds just like everybody else.
No, but the public bank of North Dakota does not use the assets to create new money. It just creates new money. That's it. It
Yeah,
does.
they do- they
You
do not
want,
lend-
I guess I'm going to ask you this: under what authority does the Bank of North Dakota create new money?
Here's an interesting
It can
point.
only create credit. I'm sorry.
Well, let me explain. The Bank of North Dakota, like other banks, there's no law that says banks can create new money out of nothing, but there's no law that prevents it. And banks have used this absence of controls, one way or the other, to, with most of their loans, they create new money because it's extremely profitable. And as long as the bank devotes those loans to public purposes, for non-inflationary beneficial purposes, that creation of money can be very beneficial and create a very stable economy.
okay,
Well, let's
Oh.
take another question, because
Yeah.
I see Joe Polito has his hand up.
Go ahead, Joe.
Thank you. That was a fascinating exchange. Terrific. Got all the adrenaline going.
that's why we're here.
And it's also been a fascinating presentation again. Each week has been terrific. Very illuminating. Just wanted to mention a couple things that I think are true. One, Werner keeps talking about his own establishment of this fact, but Kumhoff has I think it's a slideshow in which he has a quote from Schumpeter talking about the fact that, of course, Keynes has been trying to convince you economists that the banks create money. And so
I'm sorry, could you repeat that last part about Keynes?
So Kumhoff, in one of his presentations on the Chicago Plan, uses a quote from Schumpeter, Joseph Schumpeter,
Yeah,
about and he says in the quote that Keynes has been trying to convince economists for quite some time, and this is way back, I guess when he did one of his first papers, that the banks create money. And Schumpeter obviously agreed with him. So it doesn't seem like it's really a new idea. And of course, the Chicago Plan was complaining about this credit as well. So I'm always mystified by Werner doing that. But that's just an observation. Another
Oh, yeah.
observation.
But Joe Polito, it's somehow or other, it has been overshadowed by a real conviction from including bankers, not themselves lying that they don't believe that, but actually believing that the bank does not create money. So it's really a remarkable achievement of obfuscation, and that's what we're attempting to clarify, and in order to use it with public banks.
I agree. I just didn't think Werner should take all the credit he likes to take.
Well, I think he gives credit going way back to MacLeod, the law professor at Cambridge, who wrote a 2-volume treatise on banking and finance in 1855, and published that for the next 50 years. He gives credit to Schumpeter. He gives credit to Keynes in 1924 for saying banks create money out of nothing. But a few years later, Keynes changed his view without ever explaining why, or even admitting that he changed it, and he started endorsing the fractional reserve theory, where banks collectively, but not individually, create new money. And then later still, he endorsed, without ever acknowledging it, that banks just lend their deposits. So
I stand corrected.
Yeah. Yeah.
The other observation is about McGear. I think he was greatly influenced by Patman, because he asks of the Canadian, the first Canadian Bank of Canada governor, almost the exact same questions a few years later that Patman had been asking Eccles previously. And finally, it was said that the Bank of Canada stopped buying government bonds in the early 70s there. And in fact, there's a really good paper, which I put a link in the chat, which shows that the Bank of Canada did drop the percentage of bonds it purchased, but it continued to buy them. It always has. Of course, in this past, COVID period, it bought almost all the government bonds, but that's obviously an anomaly. But it never stopped. It's all my point, and that paper shows it very nicely.
Yeah. Joe, if I might add one other piece about Warner, if he has done something that the others haven't done before, it's not that his claim that banks create money. It is that he's proven it by experiments with particular banks.
Right.
So it is just like taking a theory, let's say, and then looking for what evidence actually supports this theory rather than theory 2 or theory 1. That's the achievement.
Right.
I think that the others have not achieved.
And thanks again, gentlemen. You both really know your stuff. I enjoyed it.
Thanks. I would recommend to all of you that you actually read Werner's long, detailed articles, where he gives credit and maybe blame at the same time to people who espouse all these different theories at different parts of our last 150 years, including, of course, the current dominant theory, which is that banks don't create new money, that they just lend their deposits, which Werner shows is completely incorrect.
And can you, Earl, can you put these 2 articles on chat? So that because the chat is going to be saved and people can have it later on.
Yes, I can. Ibrahim, do you have a way to email everybody the information as well? Because I could.
Yeah, send me the articles and I will just share with everybody.
Okay, I think that's an easier way to do it. It'll give me time and we can keep listening here.
Just a little detail, when Earl was talking about why the return on investment for a public bank is so high, is because they don't have lots of expenditures. And one of them was with respect to the president of a bank. So I looked up at the salary of the head of Chase, and he makes $32 million a year. And the bank that we're thinking of, the banker would be making $320,000 a year, let's say. So that's 1/100th of the income of the president of a bank, and essentially it's mostly rent. Again, it's economic rent. It appears all over the place. My definition, not my definition, but the definition of rent that I think everybody uses is anything above what you have earned by your creativity, by your work, by your contribution, etc. So they're getting away with, as John Stuart Mill used to say, making money in their sleep. It's a very, very important way of describing rent.
Very nice way of concluding, Alec. It's 8:04, and I guess unless you have any statement to make, I think we can just leave it here and meet again next week.
Yeah. Earl is going to send you out, all of you, the two pieces of legislation that we put together, one for a state public bank and one for a municipal city bank, so that you can take a look at it. And we would very much like to have a response from you as to whether or not what do you think they're worth? Do they need fixing up? Do they need altogether revisioning? Or do you think that it's a good piece of literature? Okay.
Good. I'll be happy to share them.
Okay, very good. All the best to you.
Thank you. Good night, everyone.
Bye-bye.